So we're starting with the S&P. Friday was an option expiration date, and that can serve as a turning point for markets at times. You can see that certainly happened in January, certainly happened in April. I think it's worth pointing out too that the RSI is clearly, showing signs of weakness and rolling over. The other thing, obviously, when you just look at this on a closer time frame, you can see that we were clearly consolidating here, clearly consolidating from the bottom. Now, I mean, at this point, it looks like we've broken lower. We tried to break out to the upside. That failed, and we're coming back down now. Really, to really look for more downside at this point, you need to see the market break this 59.60 area, and the level I think that needs to be broken to start looking for lower levels back into the 58.70s or even maybe even the mid 5700s. Right now, I think we're just kind of waiting to see how the market wants to bounce when we open on Monday, given that we've been seeing selling the last couple of days. We are coming into quarter end. Typically, you try to think about quarter end rebalancing. Obviously, the market's been up a lot since April, and so you would think that there would be stock for sale going into quarter end rebalancing just because the market's been up a lot. But again, we'll just kind of take it from where it is. And I think really you just need to watch and see if we actually can break this 59.60 region. It's kind of similar for the Nasdaq as well. You can see that the Nasdaq has also really been more or less just trending down to sideways. It doesn't have as much of a consolidation pattern. I mean, you can certainly make a case that this 21,600 area has been acting as a floor for the Nasdaq, and you probably would want to see the Nasdaq break that to start thinking about lower levels. Again, I guess you could kind of frame this as a descending triangle if you wanted to. That would be a bearish pattern. You also have this rolling over, or the RSI also, which would suggest momentum is beginning to fade and you're beginning to see some losses really developing there. I guess if we flip over to the credit side of the equation, right now we're looking at the high yield credit spreads for Japan, and you can see that they've been trending higher more recently. When you look at high yield spreads here in the US too, you've seen over the last couple of days spreads have been starting to widen a little bit. When you look at the investment grade spreads, those have also been starting to rise just a little bit. Again, it's not anything major, but I think it's noteworthy, and I think you have to pay attention to these things, because if you notice, IG spreads didn't really come all the way back down to where they were at their lows, and you really saw the same thing, in high yield. It didn't even get close to its lows. I mean, so I think it's important to notice that these things they're not really going down anymore, and in fact, you can make an argument that we haven't really seen high yield spreads improve since the middle of May in any meaningful way. And I think it's also, noteworthy to say that it's really the same thing even in Japan. You've actually seen them trending higher since the middle of May. And I think it's also interesting that the 10-year euro swap spread, which measures the German 10-year minus a 10-year euro swap, has also been more or less trending higher really since the middle of March. You can see it had that big move up, and then it came down, and now it's starting to at least move back up again. And so I think that these are little things that are kind of telling you something about the divergences in the marketplace, because credit doesn't seem nearly as enthusiastic as, let's say, equities have been. This is a cross-currency basis swap spread on Japan. You can see that they really haven't done anything, just kind of more or less trading sideways, also since, call it, middle of April. And when you look at a euro basis swap spread, basically the same thing, just really trading sideways. And you can take an S&P 500 chart and overlay it and see what the relationship is, and you can clearly see the difference in the performance. And so I think that this is kind of important stuff to be aware of. It's certainly, this is a euro swap, and then if you invert it, you can also see the similarities between the two. over time. And so again, you can see in this case clearly going in a divergent direction. And even when you look at it with the Japanese yen, if you can see the relationship between the two different spreads. Now this looks a little bit nicer than the other ones do, but again, it's something to pay attention to, that you're not really getting the same levels of confirmation across various asset classes. Here's the CDX high yield credit spread. When you take this and you just convert it to price instead of the spread, you'll see that it's basically, again, the same looking chart. And essentially, again, it's not really giving you that confirmation that we've seen in the S&P. In fact, if you notice, the high yield credit spreads kind of trading at levels that they were at in mid-March, and the S&P is trading at levels it was at really in mid-February. So it really just shows you the differences in terms of the recovery and how the different markets are thinking about things. And what this kind of implies to me is that the S&P probably got a little bit too extended, a little bit too far ahead of itself versus some of these other metrics. And I think that this is something worth paying attention to. It's not saying right now, at least, that the S&P is likely to return to its lows, but it is suggesting that maybe the S&P is a little bit overvalued here, and maybe we see return back into the 5,500s to 5,600s. And that certainly seems possible, and it certainly doesn't seem unreasonable either. And certainly when you just look across at some of the other sectors, I mean, here's your SMH sector, which is the semiconductors, and you can see that basically the SMH index is all it's done is just really come back to and fill the gap from mid-January. When you look at the HGX, you'll see that this hasn't really performed very well. So far, it's holding on to support at 610. But again, the housing sector has been getting pretty bad data, and you can certainly see that this has been really weakening. When you look at also Wingstop, that's also started to come back a little bit. Again, I use Wingstop just sometimes as a proxy for the overall market in terms of where it may or may not be going. When we look at some of these other metrics like the euro with like the BTIC contracts, again, we haven't really seen any form of a meaningful improvement. I think this is worth noting that this is because the contract rolled. If you take it and you adjust it, you can see it hasn't improved at all. But this is really more of a contract roll. In fact, this is now reflecting the December contracts, and you can see the December contracts haven't really changed. This is versus the effective funds rate. This contract is measured against the SOFR rate, and you can see a very similar look. So you're just not seeing a lot of confirmation across various different parts of the market. And when you look at some other things going on, obviously oil's been on the move with everything happening in the Middle East. Really, I think the important level here is 73. As long as you can stay above it, you could be seeing oil going back into the 80s. Obviously, if you break this 73 level, you can move back into the 60s. We've also obviously seen gold. Gold has been really frustrating to keep track of and to try to analyze, just because it's given so many false starts and false signals. I mean, here it looked like you had a double top with the neckline. You broke the neckline. It looked like you were going to start going lower. Then it puts in this big candle and reverses, comes back above the neckline, gives you this idea that maybe it should be taking out these highs because it's a failed double top. You can see we get back to the highs we fail, and then we start coming down again. Now we're forming what looks like a potential ascending triangle. Maybe it broke already and it's going to start heading back lower, but gold's been really like all over the place. It's not really giving us a very good indication of where it's going. I mean, you can see that vaguely there's this uptrend that's forming on the RSI that maybe suggests momentum is starting to flip back the other way. But again, even in that case, it seems like it's a little bit premature to get too bullish. It looks like it until you get above 34.20, you're just kind of waiting for some form of confirmation. And then I guess we'll just take a look at some of these European markets. Notice a DAX double top type pattern here. We fell, we broke down, came all the way back up. Now we're coming back down below it again. Notice the highs on Friday come up to resistance. That's where we fell. So right now 23,400 is acting as a pretty meaningful level of resistance. So we'll see if that level can hold. Obviously, if we get above it, you can probably start going back to the highs. As long as you stay below it, though, you have to really keep in mind that we could really see a pretty big drop. You could, 22,500 is where your first gap, and then you have another gap all the way down at 21,400, which also could come into play. And obviously, if we look at the FTSE, that's been kind of showing signs of rolling over too, clearly broken uptrend. And then finally, I guess if we just finish with some of these Asian markets, Taiwan hasn't really been performing very well, but then again, their currency has strengthened rather materially, and so that's not going to really help their stock prices out very much. And then, of course, if we just look at the Nikkei is kind of forming something that looks interesting, but yet it can't really be confirmed. Here's your potential, rising wedge type pattern that's clearly there, waiting for some sort of break in it. Here's your Nikkei and US dollar futures. That looks like it's a little bit more well-defined. Again, it looks like we're getting ready for some sort of break lower. And that could merely be because we're coming to some sort of point in the yen where we're likely to see some sort of meaningful move as well. Anyway, that's all I'm going to have for you today. We'll be back during the week. Have a great weekend, and we'll see you soon. Bye.